Let's talk about the volatility that you've seen in the recent past. Now, a number of factors playing out on the global stage have caused volatility in risk assets globally, and that means equity, also cryptocurrency, but we're speaking about equity today. You've had the inflation print in the US rise very substantially, as a result of which there's a building expectation that the US Federal Reserve will start rolling back easy monetary policy. You've had bond yields climb in that market, and you've had stocks, especially tech stocks, getting hammered pretty heavily. And as a result of which you've seen selling across the board in emerging markets and our markets as well. And then most recently you saw the volatility on account of the uncertainty in Ukraine because of what was supposed to be an imminent attack or invasion by Russia. We've felt the aftershocks of that here in India. Joining me now to talk about how you can contend with volatility is Anant Ladha of Invest Aaj For Kal. Thank you so much, Anant, for taking the time. I want to break this into three baskets. Let's talk about the trader first, because they're the ones that deal with volatility more than almost anybody else. If you are relatively new to the stock market as a trader, how do you contend with volatility?
Firstly, thank you, Alex, for having me on the show. If I talk about traders, I would first like to take 1 minute to explain why are we actually having volatility. See, in last 2 years, we saw central bank liquidity bull run, which was probably one of the best bull runs which we have had. Now there is a structural change which is about to happen. For the first time in almost last 2 years, from last 3 months, I am hearing words like quantitative easing for the first time. It means that there is a structural change which is bound to happen. Whenever we have such structural change, volatility increases. And by volatility, by no means I want to say that market will correct or market will face a heavy correction. I just want to say that what has happened in first 45 days of Feb can happen for some time, maybe for a few months more. First 15 days, we saw a beautiful rally in the market. Then market corrected sharply. Post budget, we again saw that market bounce back, and that bounce back was really good. Then again, market corrected, took support at 200-day moving average. Finally, yesterday and today, we again saw some bounce. So this is the kind of volatility which we can expect for some weeks or maybe for some time. For a trader, first most important point is change according to the market. Last few years or maybe last 1 or 2 years, I am very sure all the traders must be making a lot of money. Now they have to normalize their expectations, maybe focus more on swing trading instead of focusing more on positional trading, normalize their return targets as well for the time being. Also, traders have to follow strict stop loss. If you don't know how to follow a strict stop loss, then probably you can stay out of the market for some time. Once the dust settles down, you can come back. But if you don't know how to follow stop loss, it will be a brutal thing for you in the market. Next important point, because we have seen some good returns in last few years, many traders are feeling overconfident. Many traders are feeling that they can actually time the market. But reality is no one can time the market. So never borrow money, even from your relative or even from your wife, and invest in the market. Never do this mistake. Whatever capital you have, firstly, you should even control your quantities for the time being in the volatile market. Because irrespective of your direction, irrespective of your trades, your stop losses are bound to happen. Understand this point and control your quantity for the time being. And once we have this volatile period gone away, we will again, I personally feel that we can again resume to a beautiful market, which we were seeing from last 2 years. But for some months, or maybe for some weeks at least, you need to sustain this volatility.
Fair point. In fact, yeah, with India VIX where it currently is an indicator of volatility, I think to a large extent we've all, those people who look at the market have gotten used to seeing the figure as high it is. But it's not always this high, right, Anand? Having said that, let's talk about the next group of individuals. And this is now, I'm assuming, individuals that invest basis the fundamentals, that invest for the long term. They are not really supposed to be concerned with the daily movement of the market. If on Monday it crashes 3%, on Tuesday it's up 3%, it shouldn't affect them at all. How should these people deal with volatility? These people can actually make volatility their friend, right?
Absolutely. For long-term investors, volatile market are probably one of the best market to invest in. But you will have to frame some rules. For example, if you are investing via mutual funds or maybe via index funds, you can form a rule that every month, wherever I feel that there is a dip in the market and I want to invest some lump sum, amount equivalent to my SIP amount, I can put as lump sum. For example, if you have 1 lakh rupees of SIP, which is going per month, you can invest additionally 1 lakh rupees. Obviously, until and unless you have some bigger opportunity, like maybe correction of 25% or 30% in the market, for which you have to frame a different strategy. But in normal dips, normal correction, normal jerks of 5 to 15%, you can probably invest amount equivalent to your SIP amount. Why I am framing this amount is because at times I have seen that investors become super aggressive on the first dip. They invest complete amount on the first dip, and when there is a second dip or maybe a more correction in the market, they feel left out. In order to ensure that you don't have such feeling, follow this process. Secondly, always have your goal in mind. These uncertain times are the times where you can be not focused on your goals or maybe redeemed based on your short-term emotions. Don't do it. Always have bigger picture in mind, and whenever in doubt, zoom out. Suppose if you see last 6 months market chart and you feel that market has been choppy, zoom out and start looking at last 6 years. If you feel that last 10 months or maybe last 10 days have been choppy in the market, zoom out and see what has happened in the market in last 10 years. You will feel and you will get to know that it is part of the game. And again, you will get focused on your goals. Always have goal planning in mind, because whenever there's a goal in mind, you are emotionally attached to that goal. Whenever you will think of redeeming the amount, you will think that then how will I achieve my goal? So being emotionally attached to your goal is a good thing, but emotionally attached to market is probably a wrong thing, which you should avoid. Final important point for long-term investors, especially in mutual funds and index fund, is follow asset allocation. It is the only key to success in volatile market. If you have proper asset allocation in place, all your short-term goals are mapped to debt or maybe liquid or maybe even in FDs for that matter for the time being, then you are properly placed in the market. But if you think that just because market has given superb returns in last 2 years, you are becoming too aggressive in the market, looking at last 2 years and investing heavily for next few months or maybe few quarters, this is not a right way. Properly follow asset allocation right now.
Some very important suggestions here. And in fact, Anand, just yesterday we were talking about asset allocation and the fact that your individual goals themselves should have asset allocation strategies. So if you go either too heavy on equity or too light on equity, you can adjust them accordingly, especially if they're long-term goals. But let's talk about the last group, which is those that have a primarily individual stock-led equity portfolio. Now, they have chosen these stocks basis their own research. For example, they have maybe followed the principles that some other people have spoken about. They believe in these stocks. Is it important for these people to also have certain amount of technical analysis to understand when to dip into these stocks, when to add more into the stocks that they currently have?
See, for this, I will have a objective answer. Everything works in this market. You have to see that what works best for you. You can be a philosopher of Warren Buffett, but you have to understand that he has holding period of more than 20 years. He probably searches or maybe studies a company for maybe 5 years or 10 years and then invest his money. Have you done that research? Have you done that study? And if yes, obviously you should follow Warren Buffett's style and you should become buy and forget, invest in direct stocks as well. But if you are a normal investor, and if you don't have that much time for studying the market or studying a particular stock, I feel even as a retail investor in direct stocks, you should have strict 8 to maximum 10% stop loss in your direct stocks portfolio as well. Reason being, whenever you invest in market, you have 5 probabilities or 5 options which can happen to you. You can make superb returns or maybe very high returns. You can make nominal profit, nominal returns. Your position can be neutral, no profit, no loss kind of a situation. You can make small losses. And finally, you can completely blow up your account and you can have big losses. If you can remove this last 5th situation from your portfolio, eventually in long term, you will do really well. Also, winners of every bull run keeps on changing. Maybe there's a stock which is a blue chip stock, which is quite fundamental stock right now, but will it participate in next bull run or not? I am not sure right now. That is why never get emotionally attached to any name. Follow your strict stop loss rule. And once you follow your stop loss rule, whenever market forms a proper base and moves out for a next leg of rally, you will have sufficient buy strategy or sufficient buy signals in some good stocks, which are again fundamentally sound, and you will get to buy them at a technically right level, which you can follow. But never let a loser stock draw down your capital. I see a lot of people maybe wasting their 50% capital in a single stock. I just want to highlight one another point. If your stock is down 50%, just to reach to its cost, that stock has to rise 100%. And one question, it might be brutal, but it is the real truth. How many times have you actually taken 100% returns from a particular stock? If you don't have that capability that you can multiply your stocks, never let any stock draw down your capital. Have strict stop loss rule, plus also have buying strategies in place.
Absolutely. You hit all of the nails on their head. And in fact, it goes without saying, I'm sure you would have said this as well, stay clear of penny stocks, because what you said at the end in terms of that very sharp decline, it's almost inevitable in some of these stocks which have the kind of volatility that is almost unpredictable. Thank you so much, Anant, for taking the time. Pleasure speaking with you.
Thank you so much for having me on the show.